markets because we're still sitting right near a record high. And joining me now in studio with more is Ben Emons. He's the founder and chief investment officer of FedWatch Advisors. Ben, welcome, and it's great to have you in studio.
It's great to be here, Kristen. Thank you for having me.
Yeah, thank you so much for joining. Look, we see the market set to open fractionally higher today, still near those record highs. Do you think these levels are justified given what's going on?
I guess they are at the moment because, we don't have much impact from the tariffs on the economy as people have feared. We don't see the inflationary effects. We don't see the employment effects either. And I think that's important because as you see these announcements coming through, as you listen to them, normally this would have caused a potentially major reaction. And I think markets are in stride because not only that he's giving more time for these countries to come up with their proposals, which always helps, but I think it's about the impact at this time. So markets are currently, I think, shifting towards a different focus, which is this investment in the US that Trump has lined up with all those commitments. I think that's where the undercurrents are, why this market is staying strong at this moment.
Yeah, it has been extremely resilient that we've seen after this historic V-shaped recovery. What sectors are you watching that are indicating to you that we are starting to see a shift here in investment thesis?
Yeah, I was looking at, for example, copper, which has been a really strong component in the S&P, up like, I think, close to 50% since April. And even from yesterday, it's actually up, interestingly, despite the leverage announced. Obviously, anything related to equipment, heavy electronics, materials, I think it's all to do with that people are anticipating that the money, the commitments have made by companies and by countries to invest in the US is potentially going to be realized. I base this upon the way President Trump has managed the budget bill through Congress, which is, I think, a real political maneuver such that it's a success because it's not easy to get a bill through like that, which means the way he's negotiating has an effect, which means that he will use this as a leverage to say, well, in this budget bill, I'm giving a lot of incentive for investment, that he will go to those countries and companies and say, like, I got this legislation in place now, come invest in the US and I give you zero tariffs, and a lot of countries are probably going to follow through on this. So this is going to be a big impact in the economy.
Interesting. Okay, so with that insight, Ben, how do you anticipate these trade updates to change, if they do, between now and August 1st?
There could be more updates, obviously. There's always going to be a bit of a tension because that's the way the negotiation go. But I do think that a lot of countries will come forward and say, we're going to lower some of our non-tariff barriers in exchange for making some investments in the US so that we're getting either lower tariffs or closer to zero. That would be, I think, the positive scenario from this. The negative part will be if we're getting certain countries resisting this, say China as the key example, or Europe, that you get some sort of like interim kind of volatility. August is typically a month of volatility, typically tends to be the market not trading as well, so we'll see how it shapes up because between August 1st and August 9th is when the big deadlines really are. So that's what we're going to go up against.
I think you noted earlier, Ben, which is good to point out, that inflation really hasn't ticked higher despite concerns that we could see, even from consumers, right, their own sentiment. Inflation of 4 to 5% this year based on tariffs, and the jobs market has been staying relatively solid. What do you anticipate these Fed meeting minutes indicate today about the path forward for rates?
Well, there are two Fed members really open about cutting rates, so that will be in the minutes, that debate. But that because inflation isn't really affected much, and because tariffs are then viewed as sort of a, let's say, transitory idea, as much as that's controversial to say from a Fed perspective, that is much more reason to cut rates now than just to wait it out. Whereas the other side of the camp will be saying, well, wait a minute, we just don't really know what the tariff impact exactly will be. They did some modeling on it, and as a result, we should wait. So that you see these two camps. But I think for the market to take from it is like, although this is out there, if anything in the debate indicates that there's others who are indicating that they're willing to cut rates faster, sooner, whether that's politically driven or not, that is obviously of relevance. And lastly, it's really about the inflation itself. If it seems to be not having much of an impact, then does tariff policy really matter for monetary policy, right? Should you actually just focus on just inflation and employment, how it is behaving currently, therefore you could lower rates. And that will be a big change in tone of what we've seen so far.
What do you think is the right path forward on rates?
Well, there is a difference between where the Fed funds rate is now, where inflation is, and that difference got a bit wider. on that framework, is what Powell said himself, you have room to cut rates because you basically are more restrictive than what you should be. So I think that is a reason. I think you could cut 25 basis points in July for that particular reason. Even though that they are worried about what tariffs could do to inflation from here, because it's apparently not known. But I do think that the housing market, as an example, is somewhat suffering from a too persistent high rate. So lowering rates will have some positive effect on housing. I think that's a good thing to do.
Another factor, of course, that could impact the direction for stocks, we know, Ben, is earnings season, and that's going to kick off here soon with NYSE listed Delta, followed by the big banks, many of which list here at the stock exchange as well. Obviously, countries are needing to navigate trade with the president. What does this mean for corporations, and how quickly can they adjust their own business policies and operations to account for changes in trade?
I think they already have. There's a real rapid development that's taking place since April. And I think it's a really interesting dynamic, because it's not just US companies are doing it, but foreign companies are doing it. And it's all about market share, relative market share. So if US companies see an opportunity to gain market share from foreign companies, these foreign companies are maybe willing to absorb more in their margins to tariffs. That's what Secretary Besson talked about. It's an important piece of information, I think, for markets, because if that's true, then yes, the impact of tariffs will not be so meaningful. At the same time, the companies here adjusting their cost structure could have negative impact if they do it materially, but it seems that they're more looking at it like there's a cushion here of absorption of these tariffs that we can manage, and we just manage around it. Then I think this is why the market is up. That's why markets are viewing these tariffs as so negative as they viewed it back in April.
Yeah. All right, Ben Emons, founder and CIO of FedWatch Advisors. Ben, thanks again, especially for joining us in studio.
Absolutely. Thank you, Kristen.
It's great to
be
have
here.
you. Yeah. Okay, well.